Next up, we have a question from Casey. It says, hi, I'm DIYing my Roth IRA investments. What should I consider in investing? How would you approach target date index funds versus total market index funds? Should I invest more of one than the other? What do you think?
Do you mind if I jump in first?
I'd
just
love
because
for you
you've been
to.
so good. You've been so mature to me. I tried to complicate this because look, we're nerds. We're financial nerds. We really hyper-focus on this stuff. And I came to Bo because forever we've told you we love index investing because index investing, if you look over the long term, it outperforms the majority of the active managers. I mean, by a threshold, if you go out 10 to 15 years, it's like 80% of active managers underperform the index fund. Go look at Spiva and you can see that data yourself. So I outsmarted myself in the fact that I love target retirement funds, especially index target retirement funds, because they let you buy index funds, which I just shared why we like those. They're also very tax efficient. But I always worried people are going to screw it up for themselves. They set it, forget it, and then they don't actually change. And you're like, well, why would you have that? I have a bias because I see all of your 401k statements of prospects and everybody who comes to us with accounts, and I can pretty much tell you what decade you did what based upon your investment accounts and when you set them up, because they just reflect that. I mean, for somebody, a lot of you who are younger, you're like, what is he talking about? But like 90s, people who started the workforce in their 90s, all of a sudden I'll see where they have like the Seligman Info and Tech Fund, and they'll have the Janus 20, and I'll be like, whoa, I haven't seen these things. These are blasts from the past, but this is the type of stuff that I have seen in portfolios. And you're like, man, people get trapped and they actually outsmart themselves. So I came to you and I was like, but this is one of my nerdy moments. I was like, Bo, maybe we tell people from 30 and beyond, you ought to use index target retirement funds. But for those in their 20s, let's just keep it simple and just tell them, just use the total market index. What could go wrong? And you're like, no, that's a bad idea. I'll let you finish the story from there.
Yeah, because what ends up happening is we forget to change, or we become accustomed to a highly concentrated portfolio. And as our wealth grows, we don't necessarily want it to be a highly concentrated portfolio. We want to have a well-diversified portfolio. We want to have something that teaches us as we age, our portfolio should shift, our portfolio should change. Casey, I think what's really interesting is, so if your question, the answer to your question depends on where you are in your financial journey. If you are still in the early accumulation phase, and I'm going to say early accumulation is really pre-$300,000, $400,000, $500,000 of investable assets, I think that a target retirement index fund is a fantastic solution because all you have to do is focus on two things. How much can I save? When do I want to retire? Answer those two questions. That is it. If you want to go total market, well, you got to say, okay, do I go by total market, or do I do US S&P 500? Do I go do small cap, or do total world? Do I do all world ex-US? It just gets really, really complicated, and I don't know that adds a ton of value, because what we want you focused on is saving. Now, once your assets do hit critical mass, once you do crossover, I'm going to say $500,000 of investable assets. Well, now maybe instead of a generalized solution like a target retirement index fund, you ought to think about an individualized solution, something that focuses on your unique risk tolerance, risk capacity, goals, constraints, liquidity needs, so that you can say, all right, now I've got my Roth. I know that inside of a Roth, because it's a tax-free account, I want to hold my high growth assets. I want the things that are really, really going to do well. Those are my small cap index funds, large cap index funds, international, whatever you deem as high growth. So that then inside my 401k, okay, there I'm going to hold my conservative risk off stuff, my fixed income funds, maybe alternative funds. And in my taxable account, there I'm going to hold the stuff that spits out qualified dividends or capital gain distributions or things like that, where you can focus on not just the asset allocation, but the asset location. I don't think that's someone who's early on in their journey. I don't think that's something they should focus on. Don't major in the minors early on. Just focus on the big things that have the big impact early on in your financial journey. Your rate of return is far less important than your savings rate. So make your savings rate the emphasis, not your rate of return. Don't get caught up in that.
And if you're curious, because we can't make specific recommendations, but the biggest providers of index target retirement funds are your Fidelity Investments with their indexed Fidelity Freedom Funds,
Yep.
with Vanguard with their target retirement funds, and then Schwab has their own target retirement funds that are investing in index funds. Those are the three biggest providers. Go do some research on those things. That's a great place to start your due diligence.
Love it.